Welcome to Chapter 2 of the Life Insurance module for the LLQP course. In this chapter, I will be talking all about term life insurance, and also I do want to disclose that I do not currently have my life insurance license, and so these videos are mainly a review of the chapter in the LLQP textbook. So in this video, we will be covering 7 main topics, which will all be about term life insurance. So what is term life insurance? Well, basically, term life insurance is a contract that specifies that in exchange for a premium, the life insurance company promises to pay a death benefit if the life insured dies within the fixed term of the contract. Now, term life insurance policies have various different terms to them. The most common terms are 1 year, 5 years, 10 years, or 20 years. Most commonly, it'll be 10 or 20 years. And other terms do exist, such as 3 years, 15 years, and 30 years. There are age limits on term life insurance, so most insurance companies will not provide term insurance coverage past a specific age, which is often around age 75 or 80, and this is simply because the risk of having to make a payout is too great for the insurance company. Now, within basically any insurance policy, you have the policyholder and the life insured, and these can be the same people, but it also sometimes is different people. So the policyholder is the person who purchases the life insurance contract or later acquires ownership of it via gift or assignment. The life insured is the person whose life that the insurance contract is based on. So if the life insured dies during the term of the policy, then the insurance company must pay the death benefit. Also, within insurance, there is joint policies and there's a joint first to die, which basically is a single amount of coverage that is placed on 2 or more lives insured, and the death benefit is paid upon the death of the first person to die, which goes into the name of joint first to die. There's also joint last to die, which is the same thing except the death benefit is paid upon the death of the last person to die. You'll typically see this type of policy given to spouses, so maybe a husband and a wife have a joint policy, and either depending on if there's going to be a financial tragedy when one of them passes away, then you might want a joint first to die. Whereas if you're trying to leave money to the estate or to pay income tax or whatnot, then you may want a joint last to die policy. Now, within term life insurance policies, there is a death benefit, which is the amount the beneficiary gets when the life insured does pass away. Now, within term life insurance policies, you can have increasing death benefits, level death benefits, and decreasing death benefits. And they are quite straightforward, so there can be policies where the death benefit is level, which is the level death benefit option. You can also have death benefits that grow each year, and likewise there is decreasing death benefits where the death benefit does decrease each year. For the term insurance premiums, this basically is the amount that the policyholder has to pay the insurance company in exchange for the company's promise to pay the death benefit if the life insured dies during the term covered by the policy. There are various different factors that influence the cost of the premium, and one of the main factors is the mortality cost. And this is the approximate cost that the insurance company has when paying out the policy death benefits. So on a per policy basis, the annual mortality cost is estimated by multiplying the policy's face amount by the life insured's probability of death during the year. Meaning that in the earlier years of life, the life insured premiums will be much lower, but as they do get older, their probability of death during each specific year does get higher, which rises that mortality cost. Insurance companies also have expenses to cover. So this includes the cost of selling the policy, underwriting the policy, processing applications, etc. So this is another cost that goes into the premiums. Now, as you can see on the graph, this is basically an example of the premiums. You can see that there is an exponential growth as the policyholder becomes older. And again, that is mainly because that probability of death becomes much higher as the life insured does age. You'll also notice that at around age 75, the graph does stop. And again, that is because most insurance companies will not provide term insurance coverage past age 75 or 80, simply because the risk or probability of death is just too high. Term life insurance policies also have a renewable or non-renewable feature. So they can be either one, a renewable policy guarantees the right to renew the policy at the end of the term for another term without having to provide proof of insurability at the time of renewal. So this can be really helpful, especially if the life insured, for example, gets diagnosed with a critical illness during the final years of the term policy, because once that policy does expire, because of their critical illness, they may not be able to get another insurance policy. So their best option may be just to renew the policy that they do have. That being said, the premiums are much higher once the policy does renew. Now, the right to renew the policy is usually limited to a specific age, which is around age 70. And with a non-renewable term policy, the policy will just simply expire at the end of the term, and the policyholder must apply for a new life insurance policy if they want continued coverage. It does seem that most term life insurance policies nowadays are renewable, but it is possible that you may encounter some non-renewable policies. Term life insurance policies also can have an option where you can convert the term insurance to a permanent life insurance policy. For example, policies like whole life, term 100, or universal life policies. Now, the conversion does not require proof of continued insurability, so the policyholder can acquire lifetime protection even if the life insured is no longer insurable. The new policy issued as a result of the conversion is usually treated as an extension of the original policy. Therefore, the clock does not reset for the incontestability limitation and the suicide limitation. And converting the policy to a permanent policy either base the premiums on the current attained age, which is the attained age conversion, or they would base the new policy premiums on the original age of when the term policy was purchased, and this is original age conversion. Obviously, if they do base the premiums on attained age conversion, then the premiums will be much higher when they do convert it to the permanent policy. And then on top of that, permanent insurance tends to be much more expensive than term insurance anyway. Now, just looking at some advantages and disadvantages of term life insurance. So one of the main advantages is that there is a low initial cost. So in the early years of the policy, the premiums for term insurance will be lower than those for permanent insurance, making it much more affordable for those who cannot afford permanent policies. Premiums are also guaranteed over the term, and renewable and convertible provisions can be used to extend coverage. Also, the term of coverage can be customized to meet a specific need. The disadvantages are that premiums and coverage are not guaranteed beyond the term or renewal period, and premiums increase as the life insured ages, and they can become prohibitive. Coverage is also usually not available past a certain age, around age 75 or 80, and the policy is worthless at the end of the term. And so that is everything for Chapter 2 about term life insurance. Stay tuned for Chapter 3.